Hello everyone. Today, our topic will delve into a case study that examines the financial statement analysis of the University of Regina Club, presented by MMHoA Group 1, namely Lisa Calalo, Marilu Garcia, Madel Makawili, Enrique Efaga, and Diana Jean Duque. Our objective for this presentation is to analyze the financial statements of the University of Regina Club to gain insights into its financial health, performance, and overall management. We will cover and present the case background, the problem statement, alternative solutions to resolve the issue, some recommendations, and key insights from the case study that are applicable to our professional development. The University Club at University of Regina is a long-standing institution that serves as a social and recreational hub for the university community. It is established in 1965, a non-profit member-based corporation. The club provides a space for faculty, staff, and other members of the university to gather, network, and engage in various social activities. The club typically offers dining services, event hosting, and recreational facilities contributing to the overall sense of community on campus. Consisting of a board of directors that comprises of 10 board members governing the club that were elected from the general membership. The University Club operates under a structured governance model with key positions such as president, board members, and administrative staff. The government structure is designed to ensure effective decision-making, financial management, and overall operational efficiency. The main club objective is to promote communication, fellowship, and goodwill among individuals working within or associated with the University of Regina, and to provide quality food services, lounge facilities, recreation, and entertainment for the members. In recent years, the University Club has faced financial distress primarily due to external factors impacting its funding structure. A significant blow came from the government budget cuts by 3.5% that resulted in a reduction of subsidies provided to the university. As a consequence, the University Club experienced financial strain, leading to concerns about its long-term viability. Given this challenging financial situation, a detailed financial analysis becomes imperative. Understanding to the club's financial health through thorough examination and evaluation of financial statements, ratios, and key performance indicators will aid in making informed decisions about the future of the University Club. This analysis aims to provide insights into the root cause of financial distress, potential strategies for recovery, and the overall sustainability of the institutions. As the statement of financial position and the income statement for the years 2007 through 2016 indicated, the board was concerned that net income was negative in 7 out of these 10 years. The university valued the services that the club provided to its faculty, guests, and the professionals working at several private organizations housed in the research park on the campus. Therefore, the university subsidized these losses by writing off the accounts payable. The most recent write-off occurred in 2009, when the university wrote off the outstanding debts owed to it by the club. However, the Saskatchewan government's budget deficit is over 1.5 billion, that reduced university funding by 3.5%. With this financial crunch, the university was no longer able to subsidize the club's shortfalls. The board noted that the gross income in these 10 years is ranging from $500,000 to $700,000 that seemed to go to be an anomaly on a negative net income despite a sizable positive gross income. They wanted to dig deeper by performing a detailed ratio analysis. To give an historical overview, the inception of the University Club arose from the university's growth trajectory, necessitating a designated venue for social interactions and leisure activities. Throughout its existence, the club experienced an increase in membership and adapted its amenities to cater to the changing requirements of university populace. These are the major transformations over time. First, infrastructure enhancements, capitalizing on infrastructure improvements and upgrades to elevate the quality of the member experience. Second, program expansion, broadening the scope of programs and activities to accommodate the evolving tastes and desires of the university demographic. Third, membership adaptation, adapting the membership framework to embrace diversity and mirror the varied composition of the university community. And adversities, recent fiscal hurdles triggered by external circumstances necessitating a strategic outlook to ensure long-term viability. The University Club at University of Regina is currently facing a period of financial distress, primarily attributed to a combination of internal and external factors. One is operational costs. The club incurs significant operational costs related to faculty maintenance, staffing, and program development. These costs have been seen an upward trend due to inflation and increased demand for diverse recreation and social activities. Second, membership challenges. Fluctuations in membership levels have impacted the club revenue stream. Factors such as changing demographic, shift in member priorities, and increased competition for social and recreational options have contributed to membership challenges. The last one is the economic climate. The broader economic climate has influenced the financial well-being of the University Club. Economic downturns, inflation, and changes in consumer behavior has affected both member retention and the club's ability to attract new members. Compounding the financial distress in a recent cut in the subsidy provided by the university, a consequence of government budget cuts. The University Club traditionally received financial support from the university to help cover operational expenses and facility maintenance. However, with the reduction in the university's budget allocation, the subsidy to the club has been affected. This reduction in financial support has intensified the financial challenges faced by University Club, prompting the need for a detailed financial analysis and strategic planning to ensure the club's sustainability and continued contribution to the university community. The upcoming financial analysis will delve into specific financial metrics, proposed budgetary adjustment, and strategic initiatives to navigate through the current financial challenges. The two tables are financial statements of the University Club. The first table is a balance sheet, which is a summary of the financial position of the club at a specific point in time. It shows the club's total assets, liabilities, and equity. The second table is an income statement, which summarizes the club's financial performance over a period of time that shows the club's revenue, expenses, and net income. Looking at the balance sheet on the first table, we can see that the University Club's total asset fluctuated throughout the period with a high of $303,524.95 in 2014 and a low of $144,488.15 in 2009. Total liabilities also fluctuated throughout the period with a high of $310,082.75 in 2008 and a low of $16,775.24 in 2012. Most importantly, the balance sheet shows that the University Club's total equity was negative for all 10 years. The negative equity peaked at $139,677.40 in 2008 and lowest at negative $15,917.66 in 2016. This means that the club's liabilities were greater than its asset for each of the 10 years. Looking now at the income statement on the second table, we can see some reasons why the University Club was negative equity. The club's total revenue fluctuated throughout the period with a high of $962,722.35 in 2014 and a low of $714,852.32 in 2007. However, the club's total expenses also fluctuated throughout the period with a high of $1,021,039.36 in 2012 and a low of $508,284.83 in 2007. In most years, the club's expenses was greater than its revenue, which means that the club operated at a loss, and that's why the reason the club has negative equity. Here's a more detailed breakdown of the income statement results, revenue versus expenses. On revenue, club sales fluctuated throughout the period with a high of $714,852.32 in 2007 and a low of $451,291.97 in 2014. On average, club sales accounted for about 60% of the university club's revenue. Other revenue fluctuated throughout the period with a high of $93,311.77 in 2012 and a low of $37,063.61 in 2008. On average, other revenue accounted for is about 10% of the university club's revenue. While on expenses, the total cost of goods sold fluctuated throughout the period with a high of $236,001.85 in 2008 and a low of $183,851.83 in 2009. On average, the total cost of goods sold accounted for about 30% of the university club's expenses. On total selling and general expenses, that fluctuates throughout the period with a high of $145,315.42 in 2012 and a low of $101,614.14 in 2007. On average, total selling and general expenses accounted for about 15% of the university club's expenses. Total administration charges bonus also fluctuated throughout the year with a high of $662,463.66 in 2008 and a low of $406,670.69 in 2007. On average, the total administration charges bonus accounted for about 55% of the university's club's expenses. In conclusion, the university club's negative equity is due to the fact that the club has consistently operated at a loss. The club's expenses have been greater than its revenue in most years. This is likely due to a combination of factors such as high operational costs and declining sales. The negative net income shown in the income statement is the main culprit behind the university club's negative equity in the balance sheet. The university's subsidies wouldn't directly affect the situation as they wouldn't be reflected in these financial statements. Here's why. The university funding typically supports students' organization or specific program directly from the university itself. However, the university club, being a separated entity, doesn't receive subsidies. Then, the financial records of the club mainly focus on its own income and expenses. Since subsidies aren't earned from the club's activities, they wouldn't be listed as revenue in its financial statements. How to improve its financial issues. To improve its financial health, the university club needs to address its own internal issues that are causing the negative net income. Here are some possibilities. Cut costs. Seek opportunities to lower expenses like renegotiating supplier contracts or trimming administrative overhead. Boost income. Explore avenues to increase revenue such as introducing a new services, attracting fresh members, or raising membership fees. Enhance efficiency. Streamline operations to maximize utilization of current resources. By addressing these internal issues, the university club can turn its negative net income positive and eventually achieve positive equity. Thank you everyone for your active engagement on this presentation. Now I'd like you to introduce to my group mate, Dr. Dian, who will be leading us through the financial ratio analysis.
Good day. I'm Diana Duque, and I'm tasked to report the Part 2 of the University of Regina Club case. Now let's go to financial ratio analysis. Ratio analysis is a crucial tool in financial management that provides a comprehensive assessment of an organization's financial health and performance. It involves evaluating relationships between different financial variables to gain insights into various aspects of the business. The importance of ratio analysis includes performance evaluation, financial health, comparison and benchmarking, and forecasting and planning. Later, we will use the 2008 entries in the Exhibit 1 for sample computations of the financial ratios. Liquidity ratios such as the current ratio and quick ratio indicate the business's capacity to meet short-term liabilities. Activity ratios like total asset turnover, receivables turnover, and inventory turnover reveal how effectively the business manages its assets. Financial leverage ratios such as debt ratio, debt to equity ratio, and interest coverage ratio offer insights into a business's debt financing level and its capacity to service that debt. Profitability ratios like gross and net profit margins offer insights into a business's overall profitability. The liquidity ratios. The current ratio is a liquidity ratio that measures the ability of the business to cover its short-term obligation with its short-term assets. It provides an indication of the organization's overall liquidity and its capacity to meet the immediate financial obligations. To obtain the current ratio, divide the current assets by the current liabilities. A ratio above 1 indicates that the business has more current assets than current liabilities, suggesting a healthy liquidity position. Ratios significantly above 1 may imply an excess of idle assets, while ratios below 1 may signal potential difficulties in meeting short-term obligations. Current ratio is equal to current assets over current liabilities. So here, as an example, we will take the value in 2008. $139,189.81 in total current assets and $310,082.75 in total current liabilities. Current ratio is equal to current assets divided by current liabilities. So from the values taken from Exhibit 1 in the 2008 values, so we get $139,189.81, divide it by $310,082.75, and we get 0.45. 0.45 is less than 1, which means the club may have difficulties in meeting its short-term obligations. Now the quick ratio. Also known as the acid test ratio, it is a more stringent measure of liquidity as it excludes inventory from current assets. This ratio provides insight into the ability of the business to meet short-term obligations without relying on the sale of inventory. To compute for quick ratio, we need to subtract the inventory from current assets, then the difference of which we divide by the current liabilities. A quick ratio above 1 indicates a favorable liquidity position as the business can cover short-term liabilities without relying on slow-moving inventory. Similar to the current ratio, a quick ratio significantly above 1 may suggest excess liquidity, while a ratio below 1 may indicate potential challenges in meeting immediate obligations. For the sample calculation, we obtained the values from the 2008 entries from the Exhibit 1. If inventory is $17,807.14, so the quick ratio will be 0.39. With a quick ratio of 0.39, the university club is more likely to struggle with paying debts. The two liquidity ratios presented are the Again, these ratios provide valuable insights into the financial health and liquidity of the business, guiding decision-making and strategic planning for improved financial management. Total asset turnover. It measures how effectively a business utilizes its total assets to generate revenue, gauging the overall efficiency of asset management. A higher ratio suggests more effective asset utilization and provides insights into the business's operational efficiency and productivity. To calculate it, divide the total operating revenue by the average total assets. If less than 1, there is inefficient asset utilization for sales. If equal to 1, revenue equals total asset value. If greater than 1, there is efficient asset use generating more revenue. If the trend is increasing, there is improvement of asset efficiency over time. While if there is decreasing trend, there is declining asset efficiency uh, or possible issues. Total operating revenue is the cash inflow from primary income generating activities. So from the Exhibit 1, we obtain the values of income generating activities in the 2008 table, yielding a total of $710,415.50. To obtain the average total assets for the year 2008, we need also the value from the previous year. So we get the average of the 2007 and 2008 value of the total assets, which gives us $169,820.51. From the Exhibit 1, we have derived a while ago the values for total operating revenue and the average total asset. Now, total asset turnover is equal to the total operating revenue divided by the average total assets, which give us the value of 4.18. 4.18 is above 1, which means that the university club effectively utilizes its assets to generate revenue. Receivables turnover. This ratio assesses how quickly the business collects its accounts receivable. A higher ratio indicates efficient management of receivables. The formula for receivables turnover is the total operating revenue divided by the average accounts receivable. Receivables turnover interpretation. If the value is high, it indicates efficient management of receivables. There are quick collections and there is potential low bad debt risk. While if the value for the receivables turnover is low, it indicates inefficiency in managing receivables. The company or entity takes longer to collect receivables. The potential risk of bad debt is higher. Tightening credit policies may be necessary. Cash flow may be impacted by delayed collections. If there is a consistent value, there is steady management of receivables and there is predictable cash flow. If there is increasing trend, improvement in receivables management is seen over time, and it indicates more efficient collection practices. There's potential increase in liquidity. While if the trend is decreasing, there is deterioration in receivables management. It indicates worsening collection efficiency. There are potential liquidity issues, so review of credit policies and collection practices may be recommended. To obtain the value of the average accounts receivables, we will need the value of the previous year and the current year, then take their average. For the sample calculation, receivables turnover is equal to total operating revenue divided by average accounts receivable. If the university club has $710,415.50 in total operating revenue, and $87,444.11 in average accounts receivables, you divide the former value by the latter and you get 8.12. For the interpretation, a receivables turnover of 8.12 indicates that on average, the university club collects its receivables 8 times during the period. Note that receivables turnover can be converted into average collection period measured in days for a simpler and more straightforward comparison. Hence, average collection period is equal to days in period 365 for annual divided by the receivables turnover. Inventory turnover. This measures the efficiency of inventory management by assessing how many times inventory is sold and replaced during a period. To obtain the inventory turnover, divide the cost of goods sold by the average inventory. This table guides us in interpreting the inventory turnover. A very low inventory turnover indicates inefficient inventory management. If low, this suggests slow-moving inventory or overstocking. A moderate inventory turnover value suggests reasonable inventory management. When high, this indicates efficient inventory turnover. However, when very high, this may suggest understocking or stockouts. Generally, a higher ratio indicates efficient inventory management. A lower ratio may suggest slow-moving inventory. In interpreting the inventory turnover ratio, the interesting norms should be considered, also the seasonality and the sales trends. Companies must balance maintaining optimal inventory levels to meet customer demand while minimizing holding costs and maximizing overall operational efficiency. To obtain the value for inventory turnover, we need to divide the cost of goods sold by the average inventory. When we say average, we need to get the value from the previous year and the current year. So for our sample computation, we got the 2007 and 2000 values for the inventory and the 2008 value for the cost of goods sold. For the sample calculation, inventory turnover is equal to cost of goods sold over the average inventory. Getting from the values of 2008 entries in the Exhibit 1, we get $206,920.11 for the cost of goods sold and $17,253.92 in average inventory, which gives us an inventory turnover of 11.99, which is very high. Note that the value of 6 is the high inventory turnover. Since we got a higher value than that, so the inventory turnover value that we got is very high and it indicates understocking or stockouts. Note that inventory turnover can be converted into days in inventory through the following calculation. Days in inventory is equal to days in period, 365 for annual, divided by inventory turnover. Again, the activity ratios offer insights into the operational efficiency of the business and can guide strategies for improving asset utilization, receivables management, and the inventory turnover. Financial leverage ratios. The debt ratio. This measures the proportion of the business's assets financed by debt and indicates the entity's levels of financial leverage. To calculate the debt ratio, divide the total debt by the total assets. In interpreting the debt ratio, note that if debt ratio is less than 0.3, it means a low debt level. And indicates conservative financing and lower financial risk. If 0.3 to 0.5, moderate debt level and indicates a balanced mix of debt and equity financing. If 0.5 to 0.7, there is a relatively high debt level and suggests significant reliance on debt financing and moderate financial risk. If greater than 0.7, there is a high debt level and indicates aggressive financing with substantial portion of assets financed by debt. Potentially, there is higher financial risk. This table from the Exhibit 1 shows the total assets and the total liabilities. We get the values for the sample calculation of debt ratio from the 2008 values of the Exhibit 1. So here, If total debt is equal to $310,082.75, we divide that by the total assets, which is $170,405.25, and we get 1.82. 1.82 is a high debt level. A debt ratio of 1.82 indicates that for every dollar of assets, there is approximately $1.82 of debt. This suggests a relatively high level of debt compared to assets. So, the club may have a moderate to high level of financial leverage, potentially indicating higher financial risk. Debt to equity ratio. This ratio compares the amount of debt to the amount of equity in financing the assets of the business. Debt to equity ratio is equal to total debt divided by total equity. A ratio above 1 indicates more debt than equity financing. A lower ratio suggests a conservative financing approach. To interpret debt to equity ratio, less than 1 means more equity than debt and there's lower financial risk. If equal to 1, there's balanced proportion of debt and equity. If greater than 1, there is more debt than equity and there is higher financial risk. Significantly greater than 1 means high financial leverage and potentially risky. Note: consider industry norms for context. This table from Exhibit 1 shows where we will get the values to compute debt to equity ratio. Total debt is the total liabilities, and below that is the total equity. Debt to equity ratio is equal to total debt over total equity. If total debt is $310,082.75, we divide that by the total equity, which is $139,677.40. And then we get a value of 2.22. A value of 2.22 means a high financial leverage and it is potentially risky. So this calculation indicates that for every dollar of equity, the company has approximately $2.22 of debt. In other words, the company is financing its operations with more debt than equity, suggesting higher financial leverage. A higher debt-to-equity ratio generally indicates higher risk, as the company is relying more on borrowed funds rather than its own capital. Interest coverage ratio. The interest coverage ratio is a financial metric used to evaluate a company's ability to pay its interest expenses on an outstanding debt. It measures the company's ability to cover its interest obligation with its operating income. Interest coverage ratio is equal to earnings before interest and taxes divided by the interest expense. To interpret the interest coverage ratio, if less than 1, the company may struggle to cover interest expenses. 1 to 2, the company is barely meeting interest obligations and there is little margin for error. If 2 to 3, the company is comfortably covering interest expenses and there is a healthy financial position. If above 3, the company is strongly covering for interest payments and it indicates robust financial health. To compute for interest coverage ratio, we need first to derive the values for earnings before interest and taxes and the interest expense. First, the earnings before interest and taxes. It indicates a company's profitability. It is calculated as revenue minus expenses excluding tax and interest. The value for EBIT is equal to total revenue minus the sum of cost of goods sold and the operating expenses. Note that the EBIT is also known as the net income. When the EBIT is negative, the expenses exceed revenue. This means that the company must find funding from either investing or financing cash flows. For example, asset or bond equity sales. If a company generates more of a positive EBIT, it will need to pay a certain percentage of tax, and the net income will remain positive. However, if a company has negative EBIT, it will need to file a negative income tax for that year. So, expenses before interest and taxes is equal to the total revenue minus the sum of the cost of goods sold and the operating expenses. Note that EBIT is also equal to the net income. Interest expense is a non-operating expense shown on the income statement. It represents interest payable on any borrowing such as bonds, loans, convertible debt, or lines of credit. Understanding a company's interest expense helps to understand its capital structure and financial performance. Interest expense is equal to average balance of debt obligation times the interest rate. Assuming that the interest rate is 3.95 in 2018 Canada and the average debt is $303,068.55. So um, we get the average of debt obligation from 2007 and 2008 values, and then we multiply that average by 0.0395, and it will give us a value of $11,971.188. This table is not part of the University of Regina case. This table is just here to show where can we find the interest. The interest is often found as a separate line item near the earnings before tax and interest. Interest coverage ratio is equal to earnings before interest and taxes divided by the interest expense. Assuming that the University Club has negative $4,665.07 in earning before interest and taxes and $11,971.188 in interest expense, then we get a value of negative $0.3897, which is less than 1, and it's negative. So the club may struggle to cover interest expenses, indicating a high risk of default. When a company or entity's interest coverage ratio turns negative, it indicates that the entity is not generating sufficient earnings to pay its interest obligations. Gross profit margin. This measures the percentage of revenue that exceeds the cost of goods sold, reflecting the efficiency of the production or service delivery of the business. Gross profit margin is equal to gross income over total operating revenue times 100%. For the interpretation, if greater than 50%, it indicates a high level of efficiency in production or service delivery, suggesting strong profitability. Between 30 to 50% suggests a moderate level of efficiency and profitability with room for improvement or optimization. If between 10 to 30%, it indicates lower efficiency and profitability, potentially due to higher production costs or pricing strategies. If less than 10%, it indicates low efficiency and profitability and may signal significant challenges in controlling production costs. This table is to show where we will get the value for our sample calculation. Gross profit margin is equal to gross income, seen in the lower part of the table, divided by the total operating revenue, which is the sum of the income generating activities. Then we multiply that by 100%. To calculate the gross profit margin, divide the gross income by the total operating revenue, then multiply by 100%. Assuming that the University Club has $561,955.53 in gross income and $710,415.50 in total operating revenue, then we get a value of 79.1%. So there is a high efficiency and profitability. A gross profit margin of 71.1% indicates that for every dollar of revenue, the University Club retains $0.791 after covering the cost of goods sold. The club has high efficiency and profitability. Net profit margin. This ratio assesses the overall profitability of the business by measuring the percentage of net income relative to total revenue. Net profit margin is equal to net income divided by total operating revenue times 100%. For the interpretation, if more than 20%, there is excellent profitability and cost management. If 10% to 20%, there is good profitability with effective cost control. 5 to 10% means moderate profitability and there is room for improvement in cost management. If less than 5%, there is low profitability and may indicate inefficiencies in cost control or competitive pressures. Negative indicates losses, and there's urgent need for cost reduction or revenue increase strategies. We see the net income at the lower part of the table in Exhibit 1, while the total operating revenue, as said earlier, are the income generating activities, so we find them at the upper portion of the table. For the sample calculation of net profit margin is equal to net income divided by total operating revenue times 100%. If net income is negative $4,665.70, then divide that by total operating revenue, which is $710,415.50 times 100%, then we get a value of negative 0.6567%. Interpretation, it's negative. It indicates losses. So urgent need for cost reduction or revenue increase strategies is needed. The calculated profit margins provide insights into the operational efficiency and overall profitability of the business. Further analysis and comparison with industry benchmarks can offer a comprehensive view of its financial performance. Now, let's go to benchmarking. We will use data analysis methods. Financial analysis can leverage two main types of data analysis methods, which are the cross-sectional and the time series analysis. Cross-sectional analysis method compares different entities such as clubs or companies at a single point in time. It helps assess how similar entities perform relative to each other based on financial metrics. And two, we have time series analysis. This method focuses on a single entity over time. It involves analyzing trends and patterns in financial ratios or other metrics over a period of time, such as years or quarters. The comparison of university clubs ratio with benchmarks, Exhibit 2. We see here the liquidity ratio. Current ratio is 1.1. The university club should aim for a current ratio above 1 to ensure sufficient current assets to cover current liabilities. Their current ratio might be lower based on their financial statements. Quick ratio of 0.97. A target close to 1 is ideal. The university club might need to improve converting highly liquid assets to cash quickly. Deficiency ratios. Total asset turnover is 1.5. It is not directly applicable to clubs that don't prioritize high asset turnover. For the receivable turnover of 8.07 and average collection period of 45.47. It is applicable if the university club offers credits to members. A lower collection period or a faster collection is desirable. The solvency ratios. Debt ratio of 0.31, debt to equity ratio of 0.44. These are significantly lower than the university club's ratios due to negative equity. This suggests a more conservative financial structure for the comparable clubs. Profitability ratios. Gross profit margin of 0.67. This offers benchmark for the university club's cost of goods sold relative to sales. They can use this to assess pricing and cost control strategies. A net profit margin of negative 0.02. A negative net profit margin indicates a loss which aligns with the university club situation. However, the comparative clubs may have a slightly smaller loss. Key takeaways from the comparison. The university club likely has lower liquidity ratios, suggesting potential challenges in meeting short-term obligations. Its debt ratios are much higher, indicating a heavier reliance on debt financing compared to the more conservative approach of comparable clubs. The negative net profit margin for the benchmarks suggests that these clubs might also operate at a slight loss. But the university club's financial situation seems more concerning. Recommendations. The university club should prioritize improving its liquidity by managing current assets and liabilities more effectively. They need to address the negative net income to achieve financial sustainability and reduce their reliance on debt. Analyzing expense categories and revenue streams can help identify areas for improvement. By comparing their financial ratios to these benchmarks, the university club can gain valuable insights into their financial performance relative to similar institutions and identify areas for improvement to achieve a healthier financial position. Proposed courses of action. Increase the membership fee, increase the number of members, or close the club. The board engaged in thorough deliberations to address the university club's financial challenges. The decision to consider closing the club was undoubtedly difficult, requiring careful examinations of various factors. The potential impact of this decision loomed large, encompassing not only financial considerations, but also broader implications of the community, members, and club's reputation. The gravity of the situation demanded a comprehensive evaluation of the consequences and benefits associated with the potential closure, highlighting the complexity and sensitivity of the decision-making process. The decision-making process acknowledges that the resolution is not solely based on financial considerations. While financial distress is a significant factor, the board recognizes the broader impact on the community, the members, and the club's overall sustainability. The importance of ratio analysis becomes evident in revealing the club's viability by providing a comprehensive and quantitative assessment of financial health. Ratios serve as crucial indicators guiding the board to make informed decisions that go beyond mere financial figures and encompass the club's overall well-being and ability to fulfill its objectives.
Lastly, what are the key takeaways in this case study that can be applied to our career? Gaining proficiency in interpreting financial statements such as income statement, balance sheet, cash flow statement equips you with essential skills for analyzing a company's financial health and performance. Learning how to calculate and interpret various financial ratios helps in evaluating different aspects of a company's operation such as liquidity, profitability, efficiency, and solvency. Developing skills in financial forecasting and budgeting enables you to make informed decisions about resource allocation and planning for future financial needs. Understanding financial risk and learning techniques for risk assessment and mitigation are crucial for protecting assets and ensuring financial stability. Familiarity with capital budgeting and techniques helps in evaluating investment opportunities and making decisions regarding long-term investments in projects or assets. Learning methods for cost analysis and control aids in optimizing expenses and improving overall efficiency and profitability. Knowledge of financial reporting standards and regulatory compliance requirements is essential for maintaining transparency and adhering to legal obligations. Being able to effectively communicate financial information and insight to stakeholders, whether they are colleagues, clients, or investors, is a valuable skill in my career or in our career involving financial management. By incorporating these key takeaways into our career, whether you're in finance management, entrepreneurship, or any other field, you'll enhance your decision-making abilities and contribute to the success of your organization. Let us remember the valuable lessons learned from the University of Regina Club case study. By applying these insights to our own careers, we can strive for better financial management practices and outcomes. Thank you for your engagement and participation. Have a great day!